Welcome to another episode of Beyond the Black Letter Law. My name is Mark Morrell. I'm the Senior Marketing Manager for the DTOS Group. And together with me in collaboration is Joanne Haig, the partner of Prism Chambers. And today we're going to be discussing all things tax in Mauritius. And with us, our guest with us is Mario Hannelas, the infamous tax consultant, who is now the head of tax at the DTOS Group. So welcome, Mario. Thanks for joining us.
Yes, thank you.
Mario, it's such a pleasure to have you here. Obviously, I've known you for a few years now when you were at the MRA, long and illustrious career at the MRA. First question, how does it feel to be over to the dark side now?
Oh, it's quite an experience, you know. I've been working so long on the other side, but being given that I have a passion for taxation, and with what I've learned, it has been a great experience working with the first and last commissioner of large taxpayer. I've created the large taxpayer department. Sure. And with the MRA, I've been also working at the medium and small taxpayer department, large taxpayer in charge of international tax, representing the government, the Mauritius, at the OECD inclusive framework, tax inclusive framework, at the Forum of Harmful Tax Practices, and at the Global Forum Tax Transparency. So I've been the head of the tax treaty negotiations also. So I was heading the tax treaty negotiation team. So it was a wonderful experience.
How did it feel on your last day that you knew that's my last day as a public servant, as it were? Was it mixed emotion, or how did you feel?
Oh, it was a mixed feeling because I was very sad to leave my colleagues, because it was a wonderfully great team at the MRA.
It's really wonderful to have you on this side of the fence, I have to say.
Mario, Mauritius overhauled its tax regime significantly in 2018 to deal with the problems associated with BEPS Action 5. 4 years on, have taxpayers adapted?
You know, when you have a new system, it's always not easy to adapt, because the former system of deemed foreign tax credit were in fact applicable to all sources of income, and for obvious reason, the new system could not be applied to all sources of income, because we have, you know, the ring fencing issue. Formerly, the deemed foreign tax credit were applicable only for global business, but we had to, in order to adhere to comply with the international standard, we have to extend it to all other companies, even non-global business companies. And so it's only targeted certain sources of income, because otherwise it would have been an erosion of the tax base of Mauritius.
Yeah. Okay.
And, you know, adaptation, you have the capacity building, you have to roll out in the new system, and you have also the learning curve. I think the MRA has, after the law has published the practice note, I think it has helped a lot to understand the partial exemption, how it works in practice. And I know that adaptation has not been easy, but they are doing
it the right way. Actually, talking about the practice notes, I want to talk about SIGA, one of my favorite topics. Quite controversial at times. As you said, adaptation takes some time, and it will be certainly a journey to find out how we navigate through it. So for those of our audience who don't know, SIGA stands for Core Income Generating Activities. What do you think are some of the key considerations that taxpayer has to bear in mind when considering whether they meet SIGA for the partial exemption?
You know that we have our Income Tax Act, which talk about if you want to take advantage of the partial exemption or any tax incentive, you have to satisfy the substantial activities requirements, which are in line with the international standard which has been developed by the Forum of Harmful Tax Practices. And there are three main conditions, which are having your core income generating activities in Mauritius, and having employment. It does not say full-time employment in the law, In the income tax return, you will see they mention full-time equivalent hours, but it says you must have employment. But what is important for Mauritius is directly or indirectly. And this is when we were discussing, because there was a party to that, we were a member of the inclusive framework, we said to them that we cannot apply the same, because they wanted that the substance requirement in terms of employment should be met by the entity itself. And we discussed, we made our point, Mauritius being a small island country, we have our management company, so they accepted for non-EU state you can comply with this substance in terms of employment indirectly, that is through a management company. And thirdly, operating expenses, you must have. I think that it's a fair proposition because you can't have the cake and eat it. If a company wants to take advantage of tax incentive, they have also to bear in mind that they must have substance in Mauritius, because Mauritius has committed to be a jurisdiction of substance, and this is the price to pay. And then it's up to the company to make a sort of a cost-benefit analysis. Yeah. And I think it's a good thing to have substance in Mauritius, because creation of employment for our people in Mauritius, and spending money in Mauritius, and in return you get this advantage of a reduction in your tax bill, in your tax rate. Yeah.
And is it really done on in your experience, it's really done on a case-by-case basis, or are there some key criteria that you would recommend?
I think the practice note has gone a long way explaining. And I think when the law was out, the regulations, people did not understand core income generating activities is defined. But you will see that there are some flexibility in that it does not say core income generating activities means. It says core income generating activities include. So they give you certain, because your core income generating activities has to be done in Mauritius. Now, if you look at the activities for different sources, there are certain activities. For, let's say you are a pure equity holding, there is no question of substance as such. You have to comply with the regulatory requirements, because dividend income, there is no concern about base erosion, profit shifting. Because dividend, if you are receiving dividend from overseas, the dividends have not been deducted to arrive at profit, it's an appropriation, so there is no double non-taxation. That's why for dividend, you will see there is no question, it's just you have to comply with the regulatory requirements, and then you have enough resources to hold share participation. Whereas for other sources of income like interest, it's easy to avoid paying taxes in a country, or to have double non-taxation. So that's why it will tell you that you must have people that will value the risk, that is, will evaluate the risk of lending money, and also to monitor the loan. So you must make sure that you have either executive, apart from the strategic decision at board level, you have the executive directors who are involved in the day-to-day management, taking part in the monitoring, in evaluating, and also your people. That is, it can be done through a management company. And I think it is important also, it is said that multiple you can have multiple core income generating activities. So you need not have one main activity. You may have a lot, provided it's not incidental. But incidental also, when you look at, there was a Supreme Court case of Mauritius steam navigation. There was a principle, at that time, Mauritius steam navigation was exempted. There was a tax holiday. And the activities under the tax holiday certificate did not mention about interest on deposit, bank deposit. And what the income tax did, because I was on the income tax at the time, they tax the interest. There was surplus fund, the tax interest, but then when the case went to Supreme Court, the taxpayer won the case. the Supreme Court said that this incidental activities was so intimately connected with the main activity, which was exam, so the interest was not taxable. So that's why when you read this statement of practice, you will see that we have also mentioned about interest loan to related parties, but you have to do the core income generating measures. It talks also about interest on deposit, but I think that this should be extended also to loan to related parties. I take an example, concrete. If you have a company having dividend income, main income, and then they have surplus fund that they lend to their related, being given that the dividend is exempt, my view is that also the interest should be partially exempt.
Sure. And I think that probably deserves a podcast on its own. I think you must know that it's a controversial area. We actually are representing a few taxpayers at the moment at the level of the ARC on the basis that we actually do not agree with the view of the MRA regarding whether the interest has to be derived from the core income generating activity, as opposed to there's another school of thought that goes that so long as the core income generating activity giving rise to the interest is conducted in Mauritius, because it's all about substance in Mauritius, then the partial exemption should be available. But I'm fully aware that there are two schools of thought.
No, I think that you have to make your point before the ARC that I take an example. Let's say you have a business doing a main activity is cleaning services. This is taxed at 15%. Now they have surplus money, they invest, they give a loan or
they have treasury management activities.
They will not be entitled to partial exemption because the incidental is connected with the main business, which is taxable at standard rate. Whereas if you are a, let's say, investment holding company and you have dividend income which is partially exempt, whatever surplus money which you will give to your related companies because you are interested in the subsidiaries, because you want them to grow so that you can get dividend. So these interests, in my humble view, should, by the principle established by this case, probably you know better than me that when there is a principle and it has been established by an authority, the Supreme Court, I think that we should follow the same principle. Yeah, they should be exempt.
We'll have to agree to disagree on that. We're actually awaiting a ruling on that at the moment at the level of ERC. But it's certainly a fascinating topic, and it's just, I think it's through practice, and as the case law develops, we'll have a better idea on how to interpret those rules.
Great. Well, I'm certainly learning quite a lot sitting there. Well, now you know why Mario.
Yes, exactly. It's perfect.
Why is with us at DTOS?
Exactly.
Mario, over the years, we've introduced many tax holidays in our legislation. Do you think they are an effective way of attracting investors to our jurisdiction?
I will not say yes, I will not say no, but you know, the evidence around the use of tax incentive to attract investment are mixed.
Yeah. And
there are serious studies which have been done which show that tax incentives don't pay off in real economic gains and often fail to produce the results that were promised. And very often tax incentives also result in undesirable inequities and reward those taxpayers that they would have invest anyway, even in the absence of tax incentive. So I think better is to do like Singapore. You know, whenever Singapore have studied their system, they give tax incentives, they want result. Let's say I take the export. If you give tax incentive 3% to those who are already exporting, and they will move from 15 to, this will not change. You give on incremental. You say, okay, I want to export. If your export will increase, you will get tax incentive. And then they will effective. You want to
attach it to volume.
Yeah.
Okay.
You want to attach, for example, employment. You want to create employment. You say, okay,
Sure.
you create employment, I will give you tax incentive. You want people to invest, let's say, in sophisticated or electronic, I don't know, machine or whatever. You give them accelerated depreciation, capital allowances, or you give them investment tax credit. I think this, at the same time, you can monitor what were your objectives, have you reached that objectives. But having said this, there may be specific areas where government want to develop an area. You've seen our textile firm. We started with tax holiday. So if you have an area that we want to develop, maybe tax incentive or tax holidays may help, but here you must have a system to monitor, to properly manage the system, and have a sunset clause also. That is, you can't give tax holiday forever.
Yeah.
And also you must ensure that the one that will benefit from the tax holiday, they have substance in Mauritius.
Yeah.
In terms of employment,
Okay.
in terms of operating expenses and all that. Yeah.
And I guess going forward, that would be an OECD requirement anyway if you wanted to have new tax holidays.
And also it is said that, I think many business surveys said that other factors are more important, like rule of law, infrastructure, labor, and all that. They are more important than the taxation. And with what's happening on BEPS 2 Globe, taxation is becoming less and less important. Anyway, Mauritius, we are still an easy tax system. 15% standard rate is low, relatively speaking.
It is.
And you know what is important? Apart from effective tax rate, is a business-friendly tax administration.
Yeah.
And I know certain people may have different opinion, but I think that we have in Mauritius, the Mauritius Revenue Authority, is business-friendly.
Yes, I think on the whole, I would say yes. It's certainly a very efficient machinery, I think, in terms of when you're comparing with other government departments. I think BMR is probably one of the most efficient. I saw yesterday, actually, they were rolling out an e-invoicing system for VAT, although some of my clients asked, I've now got to buy a machine and install a software to do that. But anyway, that's for a different topic. You mentioned the GLOBE rules, and I want to talk about that a little bit. So global minimum taxation, I know you've been heavily involved at your time, the MRA, in the discussions with the OECD, etc. Now, I know that a small piece of legislation was introduced, very brief. It will be further detailed in regulations yet to be passed. Do you think for such a small country like Mauritius, there are any challenges in implementing a global minimum taxation?
Yeah, definitely. There are many challenges. One in terms of availability of data, information. Second, I think the main constraint is the capacity building. And you know, when we were talking about this new partial exemption system, but with GLOBE, it's definitely how long it will take to train people, to build capacity, to roll out new system, to educate taxpayers. This is definitely a challenge, and the GLOBE rules are very complex, very complex. They are trying to simplify matters, but certain complexities will remain, and I think from the point of view of the taxpayer, it will be an additional administrative burden. And of course, there are a lot of challenges about the choice which a country will make. Are we going to implement that domestic top-up tax? Do we need to implement that? Or do we have other alternatives like alternative minimum tax, have a fresh look at the tax incentive, because I don't think the global tax will impact materially on our, because it depends on how many M&Es, because it's target big, very large M&Es. So it will depend on how many M&Es will be impacted, but we have to wait and see what will be. The work are ongoing, and definitely there are a lot of challenges, and I know that OECD, what they are doing, they are working on the implementation framework. They are trying to develop safe harbor and all that. And so we wait for Working Party 11 is working hard. There's been a lot of progress, but there are also a lot of difficulties because there are still problems on the side of the members, certain countries, like we are talking about Pillar 2. But Pillar 1 also, there's a lot of discussions going on, and many countries say they have to go and in Pillar 1, Pillar 2. In the inclusive framework, it works like this. There are many technical committees, but then it has to come to the inclusive framework, and there must be a consensus. Now, you may disagree, but the rule there, when you disagree, you have to give your clear reason why you disagree. Yeah. Now, sometimes when they were discussing the global, there were certain who were not agreeable. They did not vote, but the majority voted. When we talk about this voting, it's concerned when they are doing the peer review of a system. Then you, as a country, they are looking at our system. We don't have a voting, but everybody must vote saying your system is, if there is one objection, then you might not clear your system.
I see. And obviously at the level of the inclusive framework, maybe I'm being a little bit cynical here, but I guess it's also questions of all animals are equal, but certain animals are more equal than others as well. Obviously, different countries will have different leveraging.
Yeah, it depends on your bargaining power. It's known that it says that you are on equal footing, but obviously the voice of America, of USA, the voice of China, the voice of India, definitely.
Well, do you think that the introduction of the minimum tax will have any adverse effects on Mauritius as an IFC?
It will have an effect on those who will be within the scope, but I don't think it will be materially affect Mauritius. Because, you know, in the globe rules, they have put the threshold, and you know about the threshold, the consolidated revenue must be equal to or greater than 750 million euros.
Quite high.
Quite high. And then there are other things, the exclusions. For example, investment funds are excluded. And there are also the minimum exclusion. There is an exclusion about in the country where you are, if your turnover is less than 10 million euro and your profit is less than 1 million, you are excluded, okay? And also there is the substance carve out. It's not the same substance that we have in Action 5, but it's a real substance, they call it. That is, they take a percentage of your payroll, and it should be entities, not indirect employment. They look at the entity that will benefit from if they are tax incentive, but they will look at the effective tax rate. Sure. But then the income that will be subject to the global minimum tax, the blending is jurisdictional. In a jurisdiction, they will look at how many entities you have. They will take the income based on the international accounting standard, that is your financial statement. And then the tax, they will look at in your company, what is your payroll cost? So for the first 10 years, they will reduce income subject to global minimum tax by 10% of your payroll, 8% of your investment in tangible assets, and after 10 years, they will reduce it to 5%.
So quite complex, actually. It's very, very complex.
But I think with all these exclusion, I'm of the view that the impact will not be that. But definitely, you know, they have aligned it with country-by-country reporting, 750. Quite a number of companies have to file the country-by-country report. And I think that to say that no company will be affected, but the majority of our global business companies will not be affected.
Okay, well, that's good news. That's very good news.
Good to hear. Mario, thank you so much for your time. It's been, Mark, I think we need a whole series on taxes.
Oh, no.
Your pleasure. I like talking about taxation. I read a lot about taxation. I have lived.
Yes, and now you're living it on the other side as well. So I think
when it's, you know, there is a big difference between theory and practice.
Yeah.
You learn in books, but when you are, the best training is on-the-job training.
Absolutely.
Experience.
I think next time bring a whiteboard and you can start drawing out your explanations for me a bit more visual than.
Yeah. No, I will. Whenever you are, you want, I will try to explain. Make it simple for you.
Sure.
And then we'll have a test for you after.
We'll have a test for Mark. Thank you so much. Right, well, listen, thank you so much for joining us, Mario. It's been a treat and really have provided a lot of clarity around tax in Mauritius. And Joanne, thank you so much again for having us and for partnering with us. And to those of you who are watching this video, please will you go and check out all our social media pages, Prism Chambers and DTOS Group, and we look forward to seeing you next time. Thank you.
Thank you.